Thank you so much for being here. This is quite a crowd for 7 a.m. This is Financially Sophisticated Firms. This is joint work with Lira Mota, who is also at MIT. So this paper is about the liability side of the firm's balance sheet. And so I'm going to start with an example of the liability side of Exelon Corporation, which is a large US utility, which finances itself with equity, so very simple, one QSIP, publicly traded, and many bonds. Other debt as well, but today we'll focus just on the bonds. And among bonds, Exelon issues many different types. So just in 23 alone, Exelon issued out of many different subsidiaries and has many different characteristics across the bonds it issued. So different credit ratings, different time to maturity, size, and even pricing. So there's, in general, lots of heterogeneity in bond characteristics, even within firm. And this is a common occurrence. It's not just Exelon. On average, firms have about 12 bonds outstanding with different characteristics. But this behavior is skewed closer to, is more so exhibited by larger companies. Okay. As another example, Ford does this too. So here I just have a snapshot from an Investor Day presentation from one of these bank-held CFO Investor Day conferences about the auto industry. And here you can see a call-out on the left side where the company says they've got a well-balanced and strong, a well-capitalized and strong balance sheet, where their funding is diversified across platforms and markets. So in this paper, I'm going to try to connect this idea of a strong, diversified balance sheet with having many different kinds of bonds outstanding. Okay, so we're going to ask first, why is firm debt structure so complex? And what is this value of this financial sophistication? Now, many papers in corporate finance document this complexity and attribute it to alleviating incentive conflicts or information asymmetries. And in this paper, we're going to focus on the investor side. So we're going to think how the investor demand side affects the firm's heterogeneity in its debt structure. And this is motivated by conversations we've had with market participants in bond markets that say that a lot of this heterogeneity across bonds is driven because that's what investors want. So we're going to have a story of heterogeneous investors that importantly face costly arbitrage. So this is going to be one of the key frictions, which means that if investors have exposure to different kinds of risks and they want to hedge those risks, and because they face trading constraints, they're unable to just trade with each other to alleviate all of these risks, which leads the firm to be able to create value by supplying assets that slice up cash flows and meet investor needs. So that allows the firm to choose bond types strategically, and in doing so, it faces a trade-off, where it's going to try, on one hand, to minimize its cost of capital, and on the other hand, it's going to try to minimize what we're going to call its funding risk, which is the firm's exposure to idiosyncratic investor demand shocks. So we're going to show causal evidence using an instrumental variable analysis of this dual purpose of market timing in the corporate bond market. And we're also going to show that this debt structure complexity, which arises from financially sophisticated firms strategically issuing bonds, they're minimizing both their cost of capital and their funding risk, and this behavior is going to create value. So a preview of our main findings. So we're going to start with a set of empirical facts. So first, we're going to define a notion of bond type. So anyone who's worked with bond markets knows there's many, many different characteristics. We're going to try to reduce the dimensionality by defining bond types along these 5 dimensions and show that firms issue many different bond types. And then we're going to show that investors specialize in different bond types. So insurers are going to hold different bond types than mutual funds. What that means from the firm is that when the firm chooses the bond type to issue, it is effectively choosing its investor base. Now, then the firm's debt structure, if they are able to choose many different bond types across many different investor groups, that's going to have implications for their funding risk, and it's actually going to increase their resilience to aggregate credit market shocks. Our paper has a theoretical framework that outlines the ideas we have, and we're going to show some empirical results that are consistent with the predictions of this framework. So first is that firms are acting financially sophisticated. So specifically, they're going to choose bond types at issuance that are both going to minimize their cost of capital and they're going to minimize their funding risk. So specifically, a 1 standard deviation decline in what we're going to call the relative credit spread of a given bond type is going to encourage the firm to issue more of that bond type by about 3% of the average issuance per assets on a monthly basis. At the same time, if the bond type has lower demand-based risk, which I'll define in a moment, that's also going to encourage the firm to issue more of that bond type. Next, we're going to show that this sophistication is going to create value. So when a firm chooses the right bond type, its equity holders are going to reward it with a small 2-day window abnormal equity return around that issuance event. Okay. So this is primarily an empirical paper. We're going to use a lot of the standard data sets used in the corporate bond literature: holdings, pricing, issuance, firm characteristics. Importantly, this data faces a common challenge, which is there's an incomplete and very challenging merge between the firms that issue the bonds and the bonds themselves. And so one of the things, one of our contributions is we're able to harmonize this merge over many steps using a variety of tools, and that we're able to increase the merge relative to words by about 25%. Our merge is available on our websites if you're interested in using it. Okay, so equipped with this merged data, we can more easily identify when Exelon, for example, issues many different bonds out of many different subsidiaries. Okay, so now let me go through some of the facts. So before I go into our facts, I have to define I'm going to define the notion of bond type. So we're going to construct 72 different bond types to reduce the dimensionality of the bond market. We're going to use these 5 dimensions: credit rating, maturity, size, covenants, and redemption. Now, this is in no means exhaustive of all the sources of variation in bonds that could affect prices. But what's useful for us is it explains about 53% of the variation in credit spreads. And so first, we're going to show that one firm can issue many different bond types. So this plot shows, out of the total amount outstanding in the corporate bond market, what share is held by firms that have at least 5 bond types outstanding. So pretty consistently, going back to the early 2000s when our data begins, you can see that about 60% of the bond market is issued by firms that have at least 5 bond types outstanding. So this is a pretty prolific phenomenon. And then next, we're going to show that investors sort into these different bond types. So here, what we've done is we've plotted all of our 72 bond types into one square. Sorry. And so we have 72 little squares, each representing one bond type. The color of that square represents the share of that bond type that is held by mutual funds versus insurance companies. Here, we're just going to use mutual funds and insurance companies for this exercise because that is they have the most comprehensive holdings in our data, and they make up about 50% of the bond market holdings. And so if all bond types were uniformly held across mutual funds and insurance companies, then you would see all of these squares would be like a light orange. But instead, you can see there's clearly selection into certain of insurers into certain bond types. For example, insurers are more likely to hold smaller bonds that are highly rated with longer duration, and mutual funds are more likely to hold lower rated, larger, potentially more liquid bonds. What this means is, from the firm's perspective, it knows when it issues a certain bond type, it has a sense for who those investors are more likely to be that are going to buy those bonds. Okay. So next, we're going to show how this complexity of debt structure affects the firm's funding risk. So to do this, I'm going to first define what I mean by funding risk. So this is a firm-level measure of its firm's exposure to idiosyncratic investor demand shocks. So you can imagine if a firm only ever borrows from one mutual fund, then it's only going to be exposed to the idiosyncratic demand shocks of that one mutual fund. Why does that matter? In our world, firms face adjustment costs, so that if it faces a negative shock and is trying to issue bonds and borrow from new investors, it's going to face costs in doing so. So ideally, the firm would like to have exposure to many different kinds of investors so that when it faces a negative shock, it has many investors to choose from. So we're going to construct a notion of funding risk empirically, first by constructing an asset level measure of what we're going to call demand-based risk. So this is going to be at the asset K level, where the source of risk arises from what we're going to call omega, which is a variance-covariance matrix of the idiosyncratic investor demand shocks. I'm going to define how I measure those demand shocks in a moment. But essentially, I'm going to then map the variance-covariance matrix of idiosyncratic investor demand shocks to the asset level using the matrix of shares of each bond type, how much is held by each investor. Okay, so I'm mapping the investor level idiosyncratic shocks to the asset level here. So the idea is if a given bond type is entirely held by one very volatile mutual fund, then its entire demand-based risk is going to be driven by that mutual fund's wealth shocks. However, if it is held by many different mutual funds and potentially also insurers, then it's essentially diversified across those different sets of investors' demand shocks, wealth shocks. Okay, now we're going to map this asset level demand-based risk to the firm level using how much of the firm's outstanding bonds are in each of these different bond types. So we're going to map this asset level demand-based risk to the firm level funding risk. Okay, so you might be wondering how this omega is measured. So we're going to have to construct a notion of idiosyncratic investor demand shocks. The idea here is we want to see fluctuations in wealth that affect funds trading that are orthogonal to the underlying fundamentals of the firms that are issuing these bonds. And so what we're going to do is we're going to use, for mutual funds, flows into mutual funds, the idea being that as households make more money through labor income, they might put more money into mutual funds, and that is plausibly exogenous to the underlying fundamentals of the bonds that the mutual fund is holding. And then for insurers, we're going to use direct premiums, with the idea being that if people buy more life insurance products, they're not necessarily buying them with what Allstate's bond portfolio is in mind. Okay. To be extra sure, we're also going to orthogonalize these flows for both the mutual fund flows and the direct premiums using contemporaneous returns, fund fixed effects, and market characteristics. This is particularly relevant for the mutual fund flows because we know that mutual fund investors could potentially learn about managers' abilities looking at returns. So we're going to look at this residualized flow. The residualized flow as our notion of exogenous flows, okay? Now, what that gives us is many thousands of funds will have some residualized flow. We're going to, again, reduce the dimensionality here. We're going to aggregate them up to 6 investor categories. So 4 different mutual fund categories, life insurers, and property and casualty insurers. And that's going to give us 6 time series, and we then collapse that into our omega matrix. That's going to be our variance covariance matrix representing the idiosyncratic investor demand shocks. Okay. So equipped with this, we can now measure funding risk and show that it actually correlates negatively with the number of bond types, as you would expect. So firms, when they have more bond types outstanding, they're then more diversified across different investors. Their funding risk goes down by our measure. Moreover, we can tie this funding risk to resilience. We can measure resilience using the firm's exposure to the CDS index. So we can measure 5-year rolling windows of the firm's beta, their CDS beta to the CDS index, as a measure of their exposure to aggregate credit risk. And we can regress the forward beta on this period funding risk and find a very robustly positive relationship, meaning as you have lower funding risk, that's going to reduce your reduce your exposure to systematic risk, and it's going to increase your resilience. So the magnitude is that a 1 standard deviation increase in funding risk will increase a firm's the firm's beta by about 5% of the average beta. Okay. Where is this coming from? The idea here is if you have very low funding risk, you're diversified across a lot of different investors. When you face a negative shock, you have many different funds to borrow from, to choose from. Okay. Now that we've had the facts, in our paper we have a model that shows the optimal capital structure that firms will choose in the face of heterogeneous investors and demand-based risk. In the interest of time, I'm just going to show a sketch of the model and show you the predictions that the model yields, because those are what we're going to test in the data. Okay, so as a sketch of the model, we have 2 periods. There's going to be 2 risk-averse investors that are mean variance, and they're going to face different exposures to an aggregate shock. So there's heterogeneity across these investors. And importantly, they're unable to borrow or short sell. So they can't just trade with each other and hedge out their risks without involving the firm. So then we have one representative firm. The firm is trying to maximize its firm value, both by reducing its cost of capital and by reducing its funding risk. The firm is going to have 2 projects that it wants to raise money off of. These projects have negatively correlated cash flows. So the firm faces the decision on if it should issue out of both of these risky cash flows, or putting them together and issuing one less risky cash flow asset. Okay, so the assets in the economy are just the firm's bonds and a risk-free savings technology that's in perfectly elastic supply. Okay, so it's a very simple model, but it yields really useful predictions that we can then test. So specifically, it's going to predict that investor demand shocks that arise in our model, they're going to arise either from changes in preferences or changes in wealth, affect equilibrium prices. Second, firms respond by selecting the bonds to issue that are trading at higher prices or lower credit spreads. Moreover, firms are also going to choose bonds to issue that have lower demand-based risk because they want to minimize their funding risk. Finally, just on this, there's going to be a trade-off between trying to minimize the cost of capital and minimize the demand-based risk, because empirically, these 2 things are actually negatively correlated. And finally, we're going to show evidence that this financial sophistication creates value. In the model, it creates value because since the investors cannot just trade with each other to hedge out their background risk, the firms can provide value by supplying assets that help the investors meet their hedging demands. So that allows the firm to create both shareholder value and enterprise value. Okay, so we're going to test each of these things in the data. So that leads us to our empirical results. Before I dive into the results, I'm going to define 2 objects. So I've been talking about prices. Since we're in bond space, we're going to just look at credit spreads. I'm going to define a notion of a relative credit spread because we want to compare across different bond types. And so a given firm faces a relative credit spread for a bond type. We're first going to construct this relative credit spread of a given bond type, K, relative to the credit spread of all other bond types in the market. And we're going to normalize by the average level of credit spreads. Now, because certain bond types are always going to trade at higher credit spreads than others, so for example, given upward sloping term structure of credit spreads, you imagine that a BBB 10-year bond typically has a higher credit spread than a BBB 2-year bond. To deal with that issue, we're going to demean all of these credit spreads by the last 12-month average. So then object that we use for prices in our empirics is going to be this notion of a relative credit spread. So it's relative both to the market and to itself, to that bond type itself. Next, we're going to define a notion of demand shocks. And we're going to construct a bond type level measure of demand shocks, aggregating up those residualized flows that I introduced to you earlier. So we're going to take those F hats that we had computed in our residualization earlier. We're going to aggregate it up to the bond type level using the holdings distribution of funds for that bond type, and we're normalizing it by market cap. Okay. So this is going to be our notion of prices, and this is our notion of demand shocks. So with these two objects, we can test our first prediction, which is do idiosyncratic changes in wealth and preferences affect relative credit spreads? And so we can just regress our relative credit spread measure on this exogenous demand. Oops, sorry. And so unsurprisingly, when there is an idiosyncratic positive shock to a bond type driven by flows into the funds that hold that bond type, the price of that bond type is going to go up and the credit spreads are going to go down. And this is true both within firm and in the cross-section. And so one standard deviation decline in a given bond type's flows is going to increase the relative credit spreads of that bond type by 1 percentage point. Okay. Next, we can test our prediction of how firms respond to these demand-driven changes in prices. So we're going to want to look at how the net issuance of a firm for a given bond type changes with the relative credit spread as well as the demand-based risk of that bond type. Okay? And so the first prediction would be that this first gamma is negative because as relative credit spreads for a given bond type are higher, that's going to reduce the firm's issuance of that bond type. Similarly, we expect the gamma 2 to be negative, meaning as a bond type has higher demand-based risk, firms are going to issue less of it. The problem, of course, we cannot run this just with standard OLS because both of these objects are likely to be endogenous. So to deal with that issue, we're going to instrument for our relative credit spread using those exogenous flows into the bond type that I had defined earlier. The rationale here, again, is that households putting more money into mutual funds or buying more policies from life insurance companies are plausibly exogenous, once we residualize for fund characteristics and returns, are plausibly exogenous to the underlying fundamentals of the bond type. We're going to use a similar instrument for demand-based risk using the changes in shares that are induced by these exogenous flows. Okay. So we can now run our IV second stage, and we show that an instrumented increase in relative credit spreads for a given bond type is going to reduce the net issuance of that bond type for a given month. And similarly, this is also true for demand-based risk. So firms don't like high credit spreads. They don't like high demand-based risk. What are the magnitudes? The 1 standard deviation decline in relative credit spreads is going to increase the average issuance size on a monthly basis by about 3%. And then a 1 standard deviation decline in demand-based risk is going to increase the average issuance size about 0.5%. Next, we can show that this behavior actually creates value. So what we're going to do is look at the 2-day event window in abnormal equity returns around the firm's issuance of a given bond. And we are going to look at it conditional on the firm issuing a bond that has a relatively lower credit spread. So they're choosing the right bond type to issue. And what we find is this positive abnormal equity return, even when you net out the constant, that amounts to about 1.4 basis points in that 2-day return. So if you were to do this trade over and over and over, that annualizes to about 1.8%. Firms don't do this, but so it's a moderate abnormal return. Importantly, this is not just a transfer from debt holders to from debt to equity, because we can also look at the return on the overall enterprise, and there's still a positive return there. And it's not going to materially increase the riskiness of the firm. So here we can look at the abnormal change in the firm's CDS around that window. And so if the improvement in the equity return was, if it also included an increase in risk, that should be reflected in the firm's CDS. And we don't find that to be the case. So we find the firms have a positive abnormal equity return, enterprise return, but no change in their CDS, in their risk. Okay. Now, you may be wondering, why are firms the ones doing this? So we know from a long literature on the role of financial intermediaries that when institutional investors face certain hedging demands, and they like certain cash flows over others, it is natural for financial intermediaries to be the ones to step in, pool cash flows from firms, tranche them, and sell them as different securities. And so what we're essentially showing is that firms in the corporate bond market are actually serving this purpose. So why might that be the case? So one hypothesis is that the financial intermediaries that typically do this are actually constrained in some way, and so they're less able to slice up the cash flows, put them on their balance sheet, and create new assets that investors demand. And so to test this, what we can do is essentially run our same baseline IV and do a subsample analysis for periods when intermediaries are more constrained using the Kelly-Manella measure of intermediary capital ratios. And so what we find is that in periods, we can interact this with our main instrumented variables, and we find that in periods when intermediaries are more constrained using this measure, firms are more likely to respond to temporary deviations in relative credit spreads here, and they're also more likely to respond to temporary deviations in demand-based risk. So what does this mean? This means that there are periods when firms are there are periods where intermediaries, who are typically the ones who are creating these different cash flows of investors, that are very constrained. And large, financially sophisticated firms can serve this purpose of creating assets with cash flows that investors like. We also find this is more so the case after the financial crisis, suggesting, this is suggestive, purely suggestive, that this might have something to do with the new regulatory regime. So we have additional results in the paper that support the mechanism that we have in mind. So importantly, there's going to be a trade-off that firms face in choosing between minimizing their credit spreads and minimizing their demand-based risk. Because empirically, these things are negatively correlated with each other. Uh-oh. Not sure what I did. Oh, here, thank you. Next, we're going to show in the paper that firms are actually providing a hedging service. So when firms issue bonds of a given bond type, the investors that are more likely to buy those bond types are exactly those that already held those bond types before, suggesting they have this hedging demand. The investors have a hedging demand for that kind of bond type that is non-satiated before the firm issues them. So firms are providing this service of meeting these hedging demands. Moreover, we show evidence of adjustment costs in that when firms issue bonds in periods when they face negative shocks, so when they're issuing bonds when they have higher CDS, they are less likely to find new lenders in those periods. What does this mean? It means that there's positive adjustment costs so that firms prefer to have many different investor relationships established in good times so that in bad times they have many to choose from. And finally, we show further evidence using COVID as a shock that firms that have higher funding risk suffer more in their bond portfolio returns given a large shock to the market. Okay. So in summary, we find that firms' bond structure reflects issuing in response to these heterogeneous investor demand shocks. And we think about this firm's capital structure optimization resembling a portfolio optimization, minimizing cost of capital and also minimizing funding risk to try to increase resilience. And so this complex bond structure allows firms to actually create value. Thank you so much for listening, and I look forward to Adriana's discussion.